Have you ever considered what superpower would grant you the ability to make the most amount of money possible? Assuming you rule out criminal activity, there's a good case to be made that the best superpower to choose to make the most amount of money would be being able to tell the future. If you knew what individual stocks or the stock market overall was going to do at any point in the future, it'd be pretty hard to not make a boatload of money from that. Now, obviously, being able to see the exact future is impossible, but that has never stopped economists from trying. The closest we have been able to come is being able to take a look at a few leading economic indicators that, when stacked up together, if they're all firing a recession indicator, have never failed. And going into the year 2024, we are currently seeing all of these leading economic indicators flash a recession warning. Now, we obviously don't know this is a certainty because we don't have a crystal ball and we don't have superpowers. But either 2024 will see a recession or this time is different. Years ago, when I was a stockbroker, one of the first promotions I was trying to get required that I had a knowledge of economic indicators, both leading economic indicators and lagging indicators. Being tested on these was part of the interview process, and to be completely honest, I just memorized them, which meant I had absolutely zero actual understanding of what these indicators were, how they worked, and most importantly, how they didn't work. I knew just enough so that when I was talking to clients, I would be able to sound educated. Meanwhile, just hoping in the back of my mind that they didn't know more than me and they couldn't tell that I actually didn't know what I was talking about. The dirty little secret was that my income didn't depend on me understanding how that stuff worked, and neither did it for any of my colleagues. My income only depended on my ability to get you to let us manage your money for a fee. Convince you that we were the smart ones, we knew what we were doing, you couldn't possibly understand all this complicated stuff, and pay us 1% to 2% every year for the rest of your life to do it for you. Meanwhile, we're investing you in products that you could do by yourself. But guess what? This stuff isn't actually that complicated. You just need somebody who will explain it to you in an easy to understand way, separate the signal from the noise, and point you in the direction that you're supposed to be looking. You still won't be able to see the future like you have a crystal ball, but you'll be able to beat the pros at their own game. Consider our first economic indicator, real gross domestic income, GDI. If you've never heard of GDI before, you've most likely heard of its close relative, GDP, gross domestic product. They are both measures of economic activity, whereas GDI counts the income in the economy and GDP looks at the value of everything being produced in the economy. Normally, the values of GDI and GDP should be almost identical because every time somebody spends money and loses money, that's somebody else's income. And if we take a look throughout history of GDI and GDP plotted together in real terms, which means we're adjusting for inflation, we can see that almost always they go up and down together. But zooming in over here on the right, we can see that recently GDI has started to move down while GDP has continued to move up. So historically, what usually takes place when GDI moves into negative territory? If you take a look at this chart, every place that you see a gray bar indicates a recession, and every place the blue line moves below the black zero line, that is GDI moving into negative territory. Now, this is not the absolute level of GDI, which would be basically moving up and to the right. This is the percentage change in gross domestic income from the year before. So every time the GDI chart is below zero, that means gross domestic income is less than it was a year prior to that point. And what you'll notice is every single time GDI goes into negative territory, we have a recession. Every time. And if we zoom in here, GDI, as of Q3 of 2023, has just moved into negative territory. But what about the fact that GDP is doing the opposite? Yes, GDI has moved negative, but GDP has continued to move higher. Do we have an example of a time when GDP continued to move up while GDI moved into negative territory? Unfortunately, we do right before the Great Recession began. GDI moved into negative territory while GDP continued to to move higher. And we had this alligator's mouth opening up right before the Great Recession, the same exact formation that we see right now. Now, this is not something obscure that nobody has ever noticed before. In fact, the Federal Reserve themselves are aware of this, with research from the Federal Reserve economist Jeremy Nalowak showing that early estimates of GDI captured the Great Recession better than GDP, and he suggested that policymakers would have been better prepared if they were looking at GDI instead. Essentially, GDI is more useful as a leading indicator of a coming recession. But if that was all we had to go on here, that would probably look like an anomaly if it was in contrast to the rest of the economic data. Don't worry, we're not done yet. We're just getting started. Consider this chart from Kurt Allwriter on Twitter that shows in the last 7 decades, there's never been a post-inversion equity market rally that has not been more than fully reversed going into a subsequent bear market. So what does that mean? It means that when the yield curve inverts, we usually have a bear market that follows. This right here is an inverted yield curve, meaning that debt with a shorter maturity has a higher interest rate than debt with a longer maturity. The yield curve inverting itself is a leading economic indicator that would point to a recession when it inverts. But beyond just a recession, we see that even when the stock market rallies after a yield curve inverts, it always reverses that rally and erases all of those gains afterwards, which does not bode well for the recent stock market rally that has happened in the S&P 500 since the yield curve inverted. Unless this time is different, all of those gains will be reversed and then some. And again, this is not something obscure that nobody is aware of. Even the Federal Reserve themselves are aware of this. And the Cleveland Fed is now predicting a recession in Q1 or Q2 of 2024. As a result of the yield curve. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, I Trust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. And they're straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. Now, luckily, there's an organization that puts together a bunch of leading economic indicators into one index. If you visit conference-board.org, you can see the data for the US leading indicators, which fell again in November. Taking a look at the first chart, we see 2 lines here, the blue line and the gray line. The blue line represents the year-over-year percentage change in the leading economic index, whereas the gray line represents the change in the real GDP. We can see that every time for the last 24 years, going back to 2000, every time the leading economic index moves severely negative, we get a recession. And the leading economic index has now been severely negative for quite some time. Looking at the components that make up this index, we see things like the leading credit index, the S&P 500 itself, the interest rate spread, which is just the difference between the interest rate on 10-year US Treasuries and the federal funds rate. We also see non-financial components like consumer expectations for business conditions and building permits and manufacturer manufacturers new orders of non-defense capital goods, and many other pieces that make up this whole index. Overall, for the 6 months ending November of 2023, it dropped 3.5%. And if we take a look at the final chart from the conference board, we can see the warning signals versus the recession signals. When the blue line, which is the leading economic index, is below that -4% line, we are past just a warning signal, and we are well in the territory of recession signal that hasn't failed in almost 2.5 decades. Again, this is no guarantee, but if we don't see a recession in 2024, that just means this time is different, and all of these leading economic indicators that have so far for decades been extremely reliable no longer work. Now let's go back to the stock market specifically here, because the stock market itself, specifically the S&P 500, is one of the things that is in the leading economic index from the conference board. We see it right here that the S&P 500 index of stock prices is one of the components of the index, and that this was the only positive contribution to the index in November. Now we've already seen how sometimes the stock market rallies right after a yield curve inverts. Yet every time this happens, the subsequent bear market erases all those gains. But we also have to take a look at the extent to which the recent stock market rally has been similar to past bull markets. If we go back to 1957, we can see all of the major advances in the S&P 500 from their bottom to their top. We can see that the current rally in the stock market, which is up 28%, is tiny relative to past major advances in the S&P 500. Now, if you're thinking, well, that's just a matter of time because we haven't had enough time yet for the full bull market to rally here. Those other rallies must have gone on for much longer. Unfortunately, not so fast, because the S&P 500 is currently up 16% from its recent low, while the Russell 2000 is up over 26% from the same low on the same day. Yet even that massive outperformance in the Russell 2000 still leaves the Russell 2000 with one of the worst 18 months performance gains since 1982 compared to all the bull markets since. Putting it all together, we have extremely reliable leading economic indicators going back decades that so far have not produced a false signal. Unless this time is different, we'll be getting a recession in 2024. Now, the stock market is not the economy. It is possible to have a recession without a bear market, but even the major advance in the stock market recently is not showing good signs going forward. Instead, quite the opposite. It is looking like a trap where retail investors are going to be buying at the top like they always do, getting suckered in, and then buying right before everything starts to sell off. The average person will, out of desperation, hold on, hoping to be able to hold it until break even, and then out of desperation, sell at the bottom. Because people usually don't sell what they want when they want. Normally, people will sell what they can when they have to. Luckily, you don't need to be in that situation if you're prepared, which is why I run Heresy Financial University now, to teach people how to self-manage their investments so that they can beat the averages and protect their portfolios from large drawdowns. And for just a couple more days, I've got a deal running with the code LASTCHANCE2023 that allows you to get Heresy Financial University for 67% off. Starting on the first of the new year, the price is going up permanently, and I will never offer this price again. So if you're on the fence, join now. Link is below. As always, thanks so much for watching. Have a great day.